Stop messing around, stop fooling around, stop delaying, stop procrastinating. Get up, get out, get it done. Everything is possible, nothing is a problem, and anything can be overcome. I just get my ass up out of bed, I get my shit together, and I get out and I start the fight. And that will transform you from a mere mortal into a superhuman being. I've never, ever, ever met anybody who told me that they got rich watching their IRA or their 401k.
Welcome back to the Daily Cash Flow. Peter, happy Wednesday. Is it Wednesday today? No, it's Tuesday.
Come on, baby. We're on a new schedule this year.
Yeah, I know. Yeah, how you doing? What's going on today?
Oh, man. George, it's a new world out there. If you're in business, if you're in real estate, whatever you're doing, you're feeling it right now. You're starting to feel it. We haven't felt it up until, I think, now. I'm talking about the economic environment, the lending environment, the access to capital, the interest rate story, what's happening globally, what's happening within our own country. Regional banks are pulled out. They're not lending. They're not really doing much business. Really, any business, if you're in real estate, the regionals are completely gone, leaving you with only the government agencies, Fannie and Freddie. And they're all over the place, too. It's a different world. The deals haven't started coming our way yet. The capitulation that we've spoken about hasn't started. There's still a disconnect, but the pain is starting to be felt. The frustration is starting to creep in. It wasn't there. Now it's here. We've gone this whole year, all of last year, the first half of this year. We haven't felt it. We're starting to feel it now. I mean, I'm starting to see it a lot, and I can only imagine what my peers and other business owners are feeling.
You know, I feel like every time we've talked over the last 2 or 3 weeks, there's fires to be put out. There's kind of intense conversations to be had. Yeah, it's a lot.
Well, we're still spending like it's the pandemic era with the free money.
Right.
Those people that have the money, they can spend it and no one cares. They certainly don't care. But the people that don't really have the money, they're still spending as if they do. The credit ratios are increasing. The savings are decreasing. When you see those charts and when you see that data, it's a little scary. For the average consumer to have decreasing savings combined with increasing credit usage, it's really going to stress the economy. We haven't really felt that, but it's going to start. It's going to start at the individual level, the very basic street individual level. We're not waiting for that to trickle down. That's going to be us, and it's going to trickle up.
Right. Yeah.
And then the trickle down is going to be that the businesses are trying to figure out how to price products. Inflation is gone, but pricing is still very high. Netflix announced today that they're going to increase pricing on their streaming services again. The writer's strike is resolved. We know where the numbers are falling out. We know what the industry is going to look like. I think Hollywood is going to be not long for the world. I think the need for studios, that whole industry of writers. I mean, have you followed the writer's strike and the resolution to the strike and the things that they've all agreed on? Yeah. I mean, they're not going to need all the studios. They're not going to need all the writers. They're not going to need all the production staff. These people are going to have to get new work, go into a completely new industry. Yeah. And that town, the city, Los Angeles, Hollywood, they're going to have to reinvent themselves. Of all the places that have a likelihood of doing that quickly, I don't think they do.
Well, and that's kind of been a conversation that's being had for a long time with Hollywood, that, a lot of film has been going to London, has been going to Atlanta, has been going to these other cities because of the legal components that go into making a film. Yeah. Yeah.
Well, but even the way the world is today, with the amount of content that the streaming services and studios have been putting out over the past 5 years, 7 years, 10 years, that's not going to continue. Right. They've got other ways to appease their subscribers' demands. And there's so much content out there right now, they can just take a pause for a while. Like, we're not consuming all of the content that they put out. And they're saying, look, we're just going to cut production. I'm not talking about moving production from a Los Angeles studio to a Toronto studio.
Yeah, just not
I'm talking about eliminating production or doing production through computer AI stuff. I mean, a lot of this writer strike was about AI.
Yeah, absolutely.
A lot of it. And the writers were able to get some really good terms regarding AI and the way the distributions work and the royalties work. That's if you're in now. If you didn't get to be a part of this particular strike and receive these terms, you're just going to have an impossible time breaking in. So the barrier to entry for new people coming into that industry is going to be really tough. And this was really largely about AI. We've been talking for a year about AI. How is it going to impact industries? This is how it's going to impact one industry. They just had a whole writer's strike and months-long negotiations about AI. What are we talking about here? We're talking about the elimination of human workforce,
Totally.
human talent.
Yeah, I was going to ask, did you see the interview with Zuckerberg and I forget the guy's name, but Lex Friedman, the Lex Friedman podcast?
I didn't see it.
Yeah, so he had an interview with Zuckerberg in the metaverse. So, and this was kind of like this updated, it was kind of Zuckerberg's way of revealing the new kind of next wave of things. And I'll tell you, it looks very realistic. It looks very close to a human being interviewed in the same room. And so, yeah, like actors are, very close to just being like, well, we have your likeness, we're good. So, yeah, it's scary.
Well, the strike addressed some of that. Look, we're still going to need actors. The industry is going to still need human nuance and editors and people to try and smooth things out. But it's going to be a whole lot less people that industry needs. If I had to bet, I would not be betting on Hollywood and Los Angeles to maintain its economic base, its employment base. I think the numbers are going to be different. I think if you rely on that industry to pay your rent and your mortgage and feed your family, and you're not already at the top with a guaranteed pipeline of work for the next decade or two, I think it's going to be really tough, if I had to bet.
All these industries are transforming, and I think it's going to look almost unrecognizable in the next.
We are feeling it. We're starting to feel it. I mean, that's just one example. The auto workers strike that's been happening. I mean, there was an announcement today that the major auto companies are going to lay off thousands and thousands and thousands of workers as a result of this strike. We could go on and on about all the different examples, but it's just starting. Be patient, sit back, watch the show, because it's going to be wild to see what happens. We're seeing the first cracks of the armor starting to happen now. The real estate stuff, it's going to really start cracking and showing its true colors over the next quarter or two, and then it's going to be a mess next year. I've been reading that some people are calling a boom in real estate for next year. I mean, I don't know what real estate they're talking about, but
yeah,
I don't think commercial real estate.
Right.
I think commercial real estate is hanging on by a thread. People are scrambling to get their financing secured and locked in. And, I don't know what's going to boom next year. I mean, home mortgage rates are through the roof.
Yeah, no, it's crazy. Rates are insane. I want to touch on that like you wrote a little while ago that higher interest rates are protecting buyers from competition.
It does.
Yeah. Can you expand on that a little bit and talk about how are buyers and sellers going to use that information to optimize for success in that way? Yeah.
So the clarity on that statement is that the higher interest rate environment protects the well-capitalized buyers from competition. Imagine higher rates makes it more difficult to get into the market, makes it more expensive for you to buy whatever real estate you're buying if you're relying on mortgages. And so if you're a home buyer, you're priced out. And if you're a home buyer that's not priced out, all those other people aren't there competing with you. So that's what I mean by the higher interest rates are protecting the real and well-capitalized buyers. If you're in my business in commercial real estate and multifamily, it's the same thing. I mean, these properties are really bonds, and they trade based on the amount of return they offer to the investor. And as the borrowing costs go up, the prices come down to compensate so that the return to the investor doesn't shift dramatically. And so with the higher interest rates and the higher borrowing costs, it's going to knock a lot of would-be buyers off the table. And the well-capitalized, seasoned, experienced people are still going to be there. There's going to be much less competition for whatever assets are going to be available. There's not a whole lot available, but for whatever is available, there's going to be less competition for it because the higher borrowing rates will knock them off the table. So if you're in the market to buy a home and you're well capitalized and maybe you don't need such a large mortgage or any mortgage, you should still stay on the hunt and remain in the market because you're going to be one of the likely survivors and beneficiaries. But if you're pushing the limits with your income and your underwriting and you're wondering how much you can afford and you watch the rates tick up and down every day and you're like, oh, I don't know if I can buy that house for my family, or, oh, I don't know if I can move to that new house that we were looking at because it's more expensive now on the mortgage. Like if you're that buyer, you're probably going to be knocked out and you're going to have to wait for a correction. You're going to have to wait for a correction. So it's going to protect some of the buyers and it's going to knock some of the buyers out. But the ones that it's going to protect is going to protect from competition.
Before we move off of real estate, I was going to do this at the end, but I feel like it makes sense to connect these two. That Globe Street had an article that came out a little while ago with like some investment themes that they're seeing, and like investment themes for like turbulent times kind of thing. That was their hook.
What did they say?
Yeah, and so that's what I'm curious about. Is like they're very like kind of quippy, short things, and I want to know what your reaction to them is. So the five things I'll do one by one. So the first one's extend to the end.
Do they say what the end means? I mean, I'm familiar with that.
Yeah.
That's what we did in 2008. Another phrase for that is kick the can. So we just got workouts and agreements with our banks, and any debt that was expiring right away, we had them just extend until the end. So that means draw out your loan maturities, ask your banks for extensions, extend till the end of the loan term. Have that dialogue with your bank. If you have a local or regional bank, they're more inclined to do a workout or to do an extension on maturing debt in this crazy market than, say, a government agency. The government agencies do not care, and they will not extend. So beware of that one. But extend to the end, kick the can. Look, a lot of us are going to have to go through that. I mean, I'm going through some loan maturities right now. I mean, it's very stressful. I'm not extending or modifying, but I got to pay it off. It just sucks that I got to pay it off in this particular environment. It's like probably at the peak or nearing the peak of what we're going to see in terms of debt cost. And it's stressful. Extend to the end. That's a good one. And yeah, that's always an option. And definitely right now, I recommend that everybody get familiar with that and start doing it.
The second one we've already touched on a little bit, that anticipate a commercial real estate boom in 2024, which you've already said kind of surprises you as an observation.
Really, that's what they there's not going to be a commercial boom in 2024. Mm-hmm. It's going to be 2024 is going to be the survive till 25. You remember we talked about that last time? Yeah, survive until 2025, extend till the end. I think we're all saying the same thing, those of us who are yanking out those cliches. I think 2024 is going to be like, hold your breath and just get through it. But if you've got the capital and you're looking for the opportunities, 2024 is going to be your moment. So I don't know if the boom is going to be the boom in opportunities. I don't think it's going to be a boom in values. I do not think real estate values are going to go up. I'm really worried about values of the housing market. I think those are going to come down. I'm really worried about values of commercial property once all of the maturing debt starts hitting the market and relying on either a sale or a refinance to save it. I think there's going to be a lot of folks that aren't going to get saved.
Number 3, seize distressed investment opportunities.
Well, okay. So yeah, next year, 2024. If you've got the money next year and in 2025, you better be well capitalized, because that's when you're going to be able to grow and thrive and build your business and find deals. Hasn't happened yet. There's still a disconnect. Mm-hmm. Next year, 2024, starting right away in January. I think we got another few months of this year with people being unrealistic, and then I think the capitulation is going to start right away in 2024. I think 2024 is going to be your year of opportunity if you've got money, if you've got capital, if you're ready. So I agree with that.
Yeah, and this one's kind of connected. Number 4, target suburban Midwest apartments.
I don't know, man. There's a lot of new supply coming on in those markets. Rents are coming down in specifically those markets. Rents are coming down there more than they are like in our neck of the woods in Northeast Corridor and New York MSA. Rents aren't really coming down. Yeah. But in the Sun Belt and in the Midwest, where all this new construction went up, and they're going to have absorption issues, I think they're going to have a tough time in 2024. So target those assets if you want to maybe buy them cheaply, but I'm not sure if you want to target those assets and pay a high price for them and be psyched that you got an asset in one of these areas. Right. I think you got to be really careful, and not buy anything market rate. Market meaning like whatever it was today or 6 months ago. Like any pricing that existed today or before is out the window. Yeah. The new pricing is going to be 15, 20, 30, 40% less. Look for those.
Yeah, so keep an eye out on longer term time horizon. I
just don't think the suburban Midwest region, did they say why? I think those areas are going to have exposure to softening market conditions.
Yeah. I think you gave the reason, which is I think they're probably cheaper up front, but they're not looking into the kind of long-term history of what's going to necessarily happen to the markets. So
I don't know. Maybe they're saying Midwest, that's where rents are going to be cheaper, so more people are going to move there to have the lower cost of housing. I mean, okay.
Yeah, potentially. Yeah, continued migration.
Yeah. But if you're a developer of a brand new building in Kansas,
right,
right now and you're going to lease it up right now, it's challenging to lease up these buildings right now to the rent levels that you need to lease them up to, because when you penciled the deal out 2-3 years ago, it was at a higher construction cost, higher land cost, lower cost of debt. So you were very aggressive. You're like, yeah, we'll get rents, we'll pencil in a 20 IRR, and we'll get people to invest. Now you're in the lease up phase and you have to absorb these newly constructed units. You're giving concessions, 1 month, 2 months free. You're lowering the contract rate. Instead of taking 4 months to lease up or 6 months to lease up your 250 unit building, it may take a year. I think you'll get through it and you'll lease it up, but you got to be able to afford to carry that thing. And if you can't, you're going to have to sell it in a not favorable environment. So I'm not sure why they said
so just be prepared.
Midwest suburban.
Yeah.
When right now what we're seeing perform is like North Jersey, Jersey City, New York's average rents are through the roof on the market rate stuff because there's no supply. I mean, it's all supply and demand driven. Wherever there's the biggest supply constraints, we'll still have high rents. But there has to be demand for housing there too. Midwest, I don't know what the demand is. Those aren't my markets, so I don't know what the demand is there. Arizona's overbuilt. Parts of Texas are going to have slower absorption, but a lot of Texas remains strong. It's not, I don't know that I agree with just generally saying Midwest suburban apartments.
Yeah.
Not sure.
Sense. And then last one, prepare the war chest.
Well, that's what we just talked about when you said seize the distressed opportunities. The only way you seize them is if you have the capital. Like the only way you get through this is if you have capital or access to capital. Like if you don't, you're going to be a seller. You're going to lose. That's going to be the deal. So sure, prepare the war chest.
Have you heard about this entrepreneurship by acquisition? It's something I hadn't heard before, ETA.
Entrepreneurship. Whoa, wait, there's an acronym for that? ETA?
Entrepreneurship through acquisition. That's the T. I said
entrepreneurship through acquisition. And what's the question about it, though? I want to know.
I think Bloomberg did a piece on it recently that there's this rising popularity with MBAs. Yeah, instead of going out and starting your own company, that you will go out and seek out companies to purchase yourself. So they'll have like an early investment round in order to find these things. And so I was wondering.
So what's the deal? Is the question like, is someone who buys a business as much of an entrepreneur as someone who starts it up from scratch? And
I think
is that the question?
Yeah, so I'm curious.
That's been a long-standing debate. I remember being with an investor up in Nantucket several years ago. Nantucket's a very expensive place. This person was a very high net worth individual. And I remember him telling me a story about his neighbor and how the neighbor was a true entrepreneur. I said, what do you mean a true entrepreneur? I never heard entrepreneur get fragmented out into different segments and definitions. I said, what's a true entrepreneur? He said, true entrepreneur. He didn't take any investors' money. He did it all on his own, built it up from his grit and hard work and his own money and savings, and didn't take investors. And I was like, oh, that's interesting. I wonder what makes that person more of an entrepreneur than someone that buys a business. He's like, if you buy a business, like you didn't really start it up. And I don't know. I don't know if it makes any difference. Look, if I start a company from scratch, or if I go out and buy something that's in existence and grow it and make it big, I think I'm still an entrepreneur in both cases. They have slightly different journeys, mostly based on the capital requirements and the startup issues. I mean, a startup is a startup. Like you're creating logos and you're finding office space or warehouse space and you're, signing leases and you're trying to find customers. Whereas if you buy an existing business, it's a going concern. There's some revenue already there, presumably. There's some customers and suppliers and vendors already there, presumably. And so it's a slightly different journey, but I think at the end of the day, once they both get to the finish line, if they get to the finish line, they will have had, after all of that, a similar journey, just not at the very beginning. Because eventually they're all going to have to deal with capital questions and capital concerns. They all have to deal with supply and demand issues, customers, cost of acquisition, location, demographics, markets. All of that stuff faces you whether you buy a business or start it from scratch. The biggest differences between the two of them are going to be in the early innings of the game. And the first inning or second inning of the game for the person that buys a business isn't going to be very similar to the person who's starting it up from scratch. So, but I don't think there's any more validity or affirmation or credibility to the entrepreneur that starts a business from nothing as compared to the entrepreneur that buys an existing company and somehow grows it.
Yeah. Well, I think, like you said, having a long-term view on these things, and that if you're sticking with it and keep going, as we say, you need to, if you're trying to build wealth, then you're going to go through all those waves of experience either way. No, I totally get that. Our last episode, you were saying how there was this feeling of heaviness that you were sensing, and I was sensing around the world in general. Do you have any practices that you use to lift yourself up when you're feeling that experience, when you're having that kind of moment?
And I feel it this week too. And it's not just the economics of things like I described at the top of this call.
Yeah,
I feel a fragility in our society. I just feel it. My spidey senses are tingling. I feel like we're all just a little fragile, a little sensitive, more than we've ever been. Sure, the economic picture is causing fragility because if we don't have certainty on where our money's coming from, it freaks us out and we can't provide for families and ourselves. But more than that, I feel like we're all on edge. Our sleep is a little messed up as a result. Our health might be messed up as a result. Certainly mental well-being and mental health is more at risk now and at recent years than I've ever seen. And I feel like the combination of all of these things and more is fraying the fabric of our society. So what do I do about it? Look, I don't sit around and have a pity party and feel bad. I want to take action and do things. So what I do is I try to help others. I feel good when I help others. And I'm not just talking about my family, but people in my life, my orbit, in my work life, people that I meet. I try to be aware of what their needs are. And if I see them having a need, I want to try and be helpful. And if someone asks me to be helpful, I definitely want to be helpful. If they take the first move and ask me, that's an important step. I try to be helpful. When I help others, I feel better about myself and I feel better about the world. It works for me. So what do you do if you're needing to make yourself feel better? I mean, some people self-medicate, some people drink, some people go for a run and get the endorphins flowing. I like to help others. It's been a consistent theme for me in my life.
No, I mean, that makes complete sense in that it takes your focus off of your own, anxiety or
it does. It reshifts the focus.
Yeah,
Reshift the focus from things maybe that you can't control to things that you can. I can control my actions and reactions. And if I feel good taking action that helps someone else and they say, wow, thank you, Peter, you've really impacted me. I mean, that makes me feel good. Yeah. And I can get through whatever the other thing is that I'm trying to get through.
Yeah.
So much so that I actually maintain a book of thank yous.
Oh, wow.
I got that from Fred Beans.
Oh, yeah.
Remember that?
Love Fred Beans. Yeah. No, I do remember that. That was it was just in his lobby, right? As we were passing through.
I went in to meet with Fred, and on the coffee table in front of me in the waiting room where I was sitting was two 3-ring binders. And both were a book of thank you. And I opened them up and started going through them. And you see all these handwritten notes and thank you notes and everything. I mean, he saved so many. I mean, it was hundreds and hundreds and hundreds of them. And he put them all together in a collection. I thought it was the most brilliant thing I ever saw.
Yeah.
And immediately I was inspired to go do the same. So I since have done the same. And we keep in the office a book of thank yous. If a tenant moves out and says thanks, we keep it. I mean, you never hear any thank yous from a tenant. When an employee has something nice to say, we keep the thank you note. When a vendor supplier sends us a thank you note for the business or a thank you for a donation or whatever it is, like it's important to remember those moments. They make me feel good. I think they make most people feel good, if we're being honest. And it's important to remember those moments and save those moments. And for me, my way of saving and remembering was to create a book of thank yous. And it's inspiring to me. Like when I'm feeling like shit and when I'm feeling beaten up, I read that book of thank yous, and it really helps.
And those things connect to the book of thank yous and the helping others. That the book of thank yous is a good reminder of like, oh, this is why I do what I do, or at least it's part of it. That experience reminds you of that.
I try to conduct myself in a way throughout my day-to-day, now and always, not just now, but always. I try to conduct myself in a way where I deliver a result so unexpected and so good that someone says thank you. And I'm not looking for a thank you because...
But it's not transactional necessarily. Yeah.
Yeah, I'm not looking for it because I like an ego thing or ego in the sense that it makes me feel good. It makes me feel like I'm having an impact. That's important for me. So I try to over-deliver and I try to create a good result in every relationship, conversation, and business dealing that I have, because if I do that enough, people recognize it. I'll get a thank you, and it's the way that I get through these things.
Yeah, I love that. You say that every investor has two constraints, capital and time. Don't squander either of them.
Well, first of all, Ray Dalio said that. Second of all, I'm going to expand on Ray's version. It's not every investor. It's every person, right? Whether you're an investor or not, as an individual, you've got three major things that you're constrained with: time, money, and health. Our job in business and our job in life is to do the most that we can with whatever we have. Some of us have a lot of money. Some of us have a little money. Whatever the amount of money is that we have in our lives, through work, through inheritance, through finding it on the floor, through working 18 jobs, through saving and investing, whatever the amount of money is that you have, your job is to do the most with it as possible, maximize it during your lifetime. So we're all constrained by money, but what are you going to do about it? What are you going to do with what you have? Don't let it be a constraint. You have to make wise decisions and use what you have wisely.
Yeah, that's what I wanted to know. Like, in what ways do you observe investors squandering their time and capital? Like, how do you defend against that?
Well, some people have a hard time making decisions, and they take no action when they should have. Some people make the wrong decision. They don't put in research, due diligence. I mean, most people don't know how to invest. Most people don't know how to take the right action, how to take calculated risks. So I think you need to become familiar with all of those concepts in order to maximize your money. And with time, George, that's an easy one. We all have a finite amount of time here. We don't know how long it is, and it's likely a lot less than we hope or think. So you got to make the most of every day. You got to fill your heart and soul with gratitude. Be happy that you're here. It can always be worse. And really use your time wisely. Allocate your time and spend your time on the things that will deliver you the most happiness, the most health, the most love, the most money, the most joy, like whatever your things are in those compartments. Like, you got to spend your time doing those things. And a lot of us don't know how to do that. Like, a lot of us are poor time allocators. A lot of us don't know what we want. A lot of people out there aren't sure about if a person's right for them, or if a move to a certain city or place is right for them, or if a job is right for them. Like, the uncertainty about all that stuff just has people flapping in the breeze and not valuing their time. I value my time more than anything. And so I try and really focus on making the right decisions with my time, my money, and lately my health too. So that's my expansion on Ray Dalio's quote.
Yeah, love that. I wanted to ask you about this wine surplus in France. Do you hear about this? That they're trying to destroy enough wine to fill 100 Olympic-sized pools, something like that?
So I've heard about it because I'm a bit of a wine enthusiast, and I know what your next question is going to be to me.
What is that?
You're going to ask me, should they destroy the wine, and should the government get involved, or should they just let the markets be free, right? Is that what you're going to ask?
Exactly, because I mean, you're a free market guy, so I was curious, like, how does that play out with someone of your mindset?
So my free market sensibilities tell me, let the wine sell at a cheap price. The government is highly vested in France's wine production,
right,
because they get VAT and taxes, and a lot of their export revenue comes from the export of wine. I mean, France makes some of the world's greatest wines, right? Yeah. So it's a big deal for the government. So they're making a decision to get involved because they want to protect their pricing for the future. They want to maintain a higher price and have a chance at having some revenue. But I don't think they should. I think they should let the markets do what they're going to do. If the wine prices get very, very cheap, that will ultimately be good for the consumer. The consumer will be able to buy more wine for less money. And they'll go through that. There'll be an absorption time frame, an absorption consideration to make. And you don't have to destroy any of the wine. You just got to sell it cheaply and quickly and then get to next year's production cycle. But they want to get involved. I don't think they should. I think you got to let the market do what it's going to do. And if you can buy Petrus for $500 a bottle now instead of $15,000 a bottle, then so be it. There was a lot of demand in the marketplace. The producers scrambled to produce more to meet that demand at these high prices, and now they're overproduced. The demand is backed off. They want to get rid of the supply to try and equalize supply and demand. I think they got to let it play out.
Yeah. 216 million that's what it's gonna cost to destroy it.
Yeah, well, I don't know. I don't know why that's a good idea. Why does the government want to spend? Well, I'll tell you why they want to spend the 216, because they think they're going to get more by spending the 216 than if they don't spend the 216. That's what the decision is that they made. But I just don't feel that government intervention is healthy for the marketplace. I think there's going to be ramifications and issues that come from them doing that.
And then last thing I wanted to touch on was preferred equity is something we touched on that several times before. We had a piece we did back in January, I think, on that. Yeah. But I'm seeing all the time now that preferred equity is kind of having a moment in multifamily, that's something that people are presenting. Yeah.
In multifamily, yes, I see that every day because that's my space, but also in other capital markets and other industries as well. Here's why. Regional banks shut down. Government agency lenders, really difficult. Interest rates, very high. Equity, there's no equity to raise from investors right now. So the capital stack is offering a window of opportunity for preferred equity. So preferred equity comes in, takes a position above the existing equity. It's preferred, so they now come first before the existing common stock or existing equity. And they're going to get paid. It takes the form of debt, but it's equity. So it's higher up in priority than the existing equity. It sits behind the secured first debt position, and it takes a higher percentage of return. Look, you can pay the preferred out and get rid of them as fast as possible. That's what the preferred equity takers want to do. If you're taking preferred equity, you want to get them in and get them out as quickly as possible. It's like a bridge or a mezz loan. You don't want them sitting there because it's a higher cost of capital, but it may be the only capital option that's available for people because the regionals have shut down and the markets are doing what they're doing, and there's just not a whole lot of money unless you make it a really good deal. The way you make it a really good deal is you give them priority, you give them security, you give them collateral, you give them a nice return. Yeah. And that's what preferred equity is.
All right, well, that's what I got today, Peter. Anything else you want to touch on, talk about before we head out?
No, thank you.
Right. Thank you. Appreciate it. I'll see you next time. If you like what you just heard, you can subscribe to The Daily Cash Flow on YouTube, Spotify, Apple Podcasts, or wherever you listen to podcasts. And we'd love it if you left us a comment or review. You can follow us on TikTok and Twitter at SiegelCap, and on Instagram at Siegel.cap. As always, if you're an accredited investor, go to SiegelCapital.com and take our survey to see if you qualify to take part in one of our apartment building deals. That's SIEGEL Capital.com.